China faces several major tax challenges stemming from its dual status as the world's second-largest economy with advanced financial systems and international trade networks, yet still grappling with a largely informal economy. These challenges are exacerbated by the need for significant government spending, which demands a broad tax base for sustainability. However, China's tax revenue stands at a mere 9% of GDP, compared to the United States' 17% at the federal level and approximately 25% when factoring in local and state revenues. This video aims not to advocate for higher or lower taxes, but to delve into the systemic hurdles China must overcome to establish a sustainable system for financing governmental activities. Understanding China's tax dilemma requires examining specific issues. Firstly, why has China struggled to increase tax collection from its vast economy? Secondly, does this low tax revenue pose a threat to its economic stability? Lastly, are there viable solutions to address this challenge? By addressing these questions, we can better assess China's position on the global economic stage. China's tax collection problem can be broken down into three core issues: inability to collect taxes from the majority of its population, effective tax avoidance by those who can pay, and misallocation of the taxes collected. With a population of 1.4 billion and a vast geographical expanse, centralized oversight becomes an immense challenge for any single entity or institution. China employs a decentralized governance structure, with authority distributed among provinces, sub-provincial regions, and cities. This delegation of responsibilities allows for more effective management of localized issues, such as trash collection schedules. In terms of funding, local governments in China primarily rely on business taxation and leasing urban land for long periods, a departure from the reliance on property taxes seen in most developed economies. Despite remitting a portion of business tax revenue to the central government, local governments retain all land leasing revenue, critical due to the size of China's real estate market. This system has come under scrutiny amid Evergrande's financial troubles, with provincial governments competing to attract land investments through infrastructure development, leading to excess infrastructure and substantial upfront investments. Provincial governments in China face constraints on issuing bonds and rely on land revenues, realized only through land rights sales. To overcome this, they utilize local government financing platforms, transferring state assets to private companies for collateral to secure loans for infrastructure projects. These loans are packaged into bonds and sold on the market. While perceived as safe due to indirect Communist Party backing, the system's vulnerability lies in limited revenue-raising capabilities, posing bankruptcy risks. Recently, real estate bonds dominated the remaining 60% of bonds, aiding development projects on leased land. However, challenges loom as COVID-19 lockdowns impact revenue streams, and investor confidence in the real estate market wanes due to bankruptcies. This diminishes revenue from land leasing, threatening the stability of the financing system. Furthermore, banks are becoming increasingly reluctant to accept land holdings as collateral for underwriting bonds issued by local government financing platforms. Complicating matters further, the Chinese central government has initiated tax returns to compensate citizens for lockdowns while simultaneously advocating for additional infrastructure projects to counteract the economic repercussions of these lockdowns. This dual dynamic translates to reduced incoming revenue, heightened expenditure, and limited avenues for financing. Adding to the complexity, the Chinese bond market primarily consists of highly speculative financial assets, often perceived as too safe to fail due to their backing by the booming real estate market. This situation may evoke concerns reminiscent of past financial crises. Compounding these concerns is the fact that nearly all bonds issued in China hold at least AA ratings, with local government financing bonds typically rated AAA, misleading investors into perceiving them as the safest possible investment, contrary to reality. The enormity of the $19 trillion bond market, predicated on perpetual growth, raises alarming implications. While it's tempting to believe that the central national government would intervene to bail out local governments in the event of a market collapse, there's a looming uncertainty about their capacity to do so. The Chinese bond market dwarfs the global mortgage-backed securities market, and its potential collapse could be catastrophic. Moreover, the issue of expiring land leases adds another layer of complexity, as some shorter leases have already started to lapse, posing a significant challenge for the government to address. As the expiration of land leases looms, the fate of the land remains uncertain. Land was expected to revert to the government at the end of the lease period, a notion met with strong opposition from citizens facing the prospect of losing their homes and investments. Many Chinese citizens now believe that the government will not reclaim the land due to the immense political backlash it would provoke. This belief is reinforced by market dynamics, where properties with shorter lease terms are priced similarly to those with longer terms, suggesting an expectation that leases will be indefinitely extended. Moreover, the quality of construction in China often means that buildings may not endure for the entirety of long-term leases, further complicating the situation. Recent laws proclaiming automatic renewal of residential land rentals have added to the confusion. However, these laws remain ambiguous regarding whether the renewals will be free or entail additional fees. The intentional vagueness of these laws, as admitted by a member of the drafting team, reflects a reluctance to take responsibility for determining the resolution of this issue. Should the government choose to extend land rentals indefinitely without imposing further fees, they risk foregoing a significant revenue stream. This dilemma exacerbates China's broader tax problem, tax evasion. Despite the existence of progressive income taxes ranging from 3% to 45%, many citizens evade taxes, contributing to the challenges faced by the government in revenue collection. The crux of China's tax dilemma lies in the widespread non-compliance with formal income taxes, particularly among those engaged in the informal economy. The majority of Chinese citizens work in informal sectors, such as small businesses or farming, where transactions are often conducted in cash or through digital platforms like WeChat. Conversely, individuals at the higher end of the income spectrum often funnel their earnings through businesses and assets, significantly reducing their tax liability. Consequently, only a small minority, those neither wealthy enough to evade taxes nor employed in the formal sector, end up bearing the brunt of tax obligations. Numerous scandals involving prominent Chinese figures engaging in tax avoidance have surfaced, highlighting the government's leniency towards enforcement. While the government could crack down on tax evasion if it desired, it refrains from doing so for two primary reasons. Firstly, lax regulations surrounding business taxes stimulate economic activity, which has been a linchpin of China's remarkable economic growth. Secondly, the threat of potential tax investigations serves as a powerful tool for silencing dissenting voices among celebrities or business leaders. China's heavy reliance on taxation from a mere 2% of the population is unsustainable, burdening compliant taxpayers unfairly and constraining government revenue. Effective economic management requires a broad tax base, which China lacks, hampering control mechanisms during downturns. Taxes are a potent tool for economic management, but their efficiency hinges on a broader tax base. Without it, effective economic management becomes akin to navigating a jumbo jet with only a hand fan for control. Now turning to China's economic standing. Its GDP of $14.7 trillion solidifies its position as the world's second largest economy, earning a perfect 10 out of 10 in terms of size. However, when considering GDP per capita, which stands at $10,400, China falls into the category of a middle-income country by global standards. Despite criticisms, China has undeniably experienced unprecedented economic development. Its GDP per capita aligns closely with the global average of $10,900, warranting a neutral score of 5 out of 10. Stability and confidence in China's economy are challenging to assets. Despite its undeniable economic strength and global dominance, concerns linger over sovereign risk and government's arbitrary actions, including business and individual erasures. Moreover, uncertainties related to lockdowns and military ambitions further impact confidence. Thus, while China's economy is expected to endure, these factors contribute to a stability and confidence rating of 6 out of 10. China's economic growth has been nothing short of remarkable, with its transformation into a major economic superpower seemingly unimaginable just a few decades ago. Since 2010, China's economy has more than doubled in size, and compared to the year 2000, it's now over 10 times larger, an impressive feat deserving of a perfect score of 10 out of 10. No other economy in history has achieved such staggering growth. In terms of industry, China's ascent as the workshop of the world has been instrumental in its economic success. Initially known for low-cost manufacturing and serving as a destination for foreign companies seeking affordable labour, China has evolved into an unrivaled industrial hub with a sophisticated financial system, a thriving domestic market, and globally recognised local companies. While it may not excel in producing high-end goods like airliners or cutting-edge microprocessors, its overall industrial prowess warrants a perfect score of 10 out of 10. With these assessments, China achieves an average score of 8.2 out of 10, securing its position as the second largest economy on the Trees Economy leaderboard. We focused on China's major tax problems in this video. If you found this video helpful, don't forget to like, share and subscribe for more valuable content. Thanks for watching, and I'll see you in the next video.